Corporate funding doesn't happen in a vacuum. Treasurers operate in a world where interest rates shift quickly, yield curves twist unpredictably, and capital markets can open or close within days. In volatile rate environments, the challenge is not simply minimizing cost, it's managing risk, timing, and flexibility. Understanding how the yield curve interacts with funding choices is essential for strategic decision making. A steep yield curve, where long-term rates are significantly higher than short-term rates, traditionally encourages corporates to finance short and gradually term out their debt. Commercial paper programs, short-dated loans, and rolling facilities become attractive. However, this increases rollover risk. If a shock occurs and short-term markets freeze, corporates may face sudden refinancing pressure. An inverted curve presents the opposite scenario. Long-term fixed-rate funding may be temporarily cheaper relative to floating short-term rates. While the absolute yield may be high, the relative value can be compelling. Corporates that lock in long-term funding during inversions can create meaningful savings over the life of the debt. Derivatives add further flexibility. Interest rate swaps allow corporates to convert floating rate obligations into fixed rate liabilities or vice versa. Forward-starting swaps lets treasurers lock in rates ahead of future issuance windows. Collars, combining caps and floors, can provide budget certainty while still allowing participation if rates fall. Cross-currency swaps can help multinational companies borrow where markets are cheapest and deepest, then convert the exposure to the desired currency. Market accessibility is another consideration. Investment-grade companies may shift between the bond market and private placements depending on pricing and investor appetite. High-yield issuers may rely more on secured debt or term loans when risk premia widens. Understanding which market offers favourable terms is a key strategic function. Treasury teams must also manage duration at the liability level. Extending duration reduces financing risk but increases sensitivity to rate changes. Shortening duration reduces rate sensitivity but increases rollover exposure. Balancing these trade-offs requires scenario analysis, particularly in uncertain macro environments where rate paths are unclear. In volatile market, corporate funding strategy becomes a dynamic process. The shape of the yield curve, the choice between fixed and floating, the use of derivatives, and the timing of issuance all matter. The companies that manage these dimensions proactively rather than reactively turn rate volatility from a source of risk into a source of opportunity.